Hey everyone, and welcome to This Explainer. Today, we're diving into something that honestly gets an unfair rep. We're going to take what most people think of as just a bunch of dry, boring business documents and reveal what they actually are: a living, breathing playbook of commerce. If you've ever wondered how the massive gears of global business actually turn, well, the secret isn't hidden in some fancy boardroom. It's in the paper trail. Every single transaction leaves a footprint. And today, we're going to learn exactly how to track them down. So here's our map for the paper trail today. We're going to cover the business paper trail, invoices and discounts, how to fix errors with notes, the statement of account, and finally, payments and bank statements. Let's kick things off with part one, the business paper trail. Moving right along to part two, invoices and discounts. Think of this as the initial credit sale. It's literally the spark that ignites this entire accounting process. Now, this is where things get kind of fascinating. It's what I like to call the two-way mirror of business. Imagine the single piece of paper acting as two completely different records, totally depending on which side of the desk you're sitting on. When a credit sale happens, the seller creates an invoice. To the seller, the copy they hold on to is a sales invoice. But to the customer who pulls it out of their mailbox, that exact same piece of paper is a purchases invoice. It's one single transaction, but two completely distinct accounting realities. Wild, right? Okay, before we get into the math, we really need to demystify discounts because businesses use two very different types, and it's easy to get them mixed up. First up is the trade discount. This is basically a reward for bulk buying or just being a super loyal customer. The crucial point you got to remember here is that a trade discount is simply a deduction from the list price right there on the invoice, and it never actually hits the formal accounting ledgers. The cash discount, on the other hand, is a totally different beast. This is an incentive given to customers for prompt payment, like taking 2% off if you pay within 30 days. Since it completely depends on when the customer pays, it absolutely must be recorded in the books of account. Let's see how this plays out in a real-world scenario. Imagine a supplier, Mason & Son, selling to Ace & Company. The buyer wants 2 rolls of copper wire at $30 each and 1 roll of insulation tape at $10. That brings our subtotal to $70. But because a 10% trade discount is applied, we deduct $7 right off the top. So the final invoice total drops down to $63. When both companies go to record this in their ledgers, they're both going to record the transaction at $63. That original $70, it just completely vanishes from an accounting perspective. Poof. But let's be real, business is rarely perfect. What happens if Ace & Company rips open that box and the copper wire is the wrong gauge? Or maybe the insulation tape is completely mangled. You can't just cross out numbers on the original invoice with a red marker. We need a formal, official paper trail to adjust that debt. Which brings us to part 3, fixing errors with business notes. So when things inevitably go slightly sideways, 2 main notes come into play: the debit note and the credit note. Let's look at an example with a customer named M. McKenzie and a supplier named C. Cassidy. Say McKenzie ordered 5 dining sets, but when they showed up, they were totally the wrong size. McKenzie immediately issues a debit note to Cassidy. Think of this document as a formal request saying, "Hey, I'm returning these, please reduce my bill." But remember, it's just a request at this stage. When the supplier, Cassidy, actually receives the dining sets back and agrees with the return, then they issue a credit note. This is the official acknowledgement. That credit note is basically the golden ticket that officially reduces the customer's debt in the supplier's accounting books. Now for part 4, the statement of account, or the monthly roundup. At the end of every month, the supplier generates a statement of account. If you want to wrap your head around this one instantly, just think about your own personal monthly credit card bill. It's a summary of absolutely all your account activity: every purchase, every return, every payment you've made over the last 30 days, all culminating in one crystal clear number: the balance you owe right now. In the business world, its main job is to remind customers to pay up, while also giving both parties a chance to double-check for any pesky errors. Let's break down a real statement of account from Lima Furniture Suppliers to see exactly how this running total works. Notice how it tells a complete chronological story. On June 1st, the customer already owed $3,400. On June 6th, they bought more stuff, so invoice 34/F adds $2,400 to their debt, bringing the balance up to $5,800. But then, on June 10th, there's note 5/G for $300. That's a credit note for a return, which drops the balance back down to $5,500. They send over a check on the 15th, bringing the debt way down to just $1,000. Finally, one more invoice on the 20th brings the end-of-month total to exactly $2,000. It is a perfect, completely transparent summary of their business relationship. And finally, part 5, payments in statements, where we finally settle the score. Now, I know a lot of businesses today run on electronic transfers, but the traditional check is still the absolute best way to visualize this paper trail. Think about the anatomy of a check. When you write one out, you hand the main portion over to the supplier. But that little perforated piece left behind in your checkbook, that's the counterfoil. For the person actually paying, that tiny little stub is the ultimate source document. It proves they wrote the check, and it's what they use to record the payment in their own accounting ledgers. But wait, what if you aren't buying on credit at all? What if you're just handing over cash on the spot? Well, in that case, you just skip the invoices, the debit notes, and the statements entirely. You simply hand over the cash and you get a receipt. It's a formal, written acknowledgement that the money was received. Cash sales generate immediate entries right into the cash books, totally bypassing that entire credit lifecycle we were just talking about. Ultimately, though, whether we're talking about checks, electronic transfers, or cash deposits, it all eventually flows into the bank. The bank statement is the grand finale of our paper trail. It's an independent third-party record summarizing all your deposits, withdrawals, checks, and, yes, those annoying fees. And businesses don't just file these away in a drawer. They actively use them to reconcile against their own internal records. Regularly checking this statement is exactly how a business detects hidden errors, prevents devastating fraud, and makes sure they don't accidentally get slammed with massive overdraft fees. It's absolutely crucial. So, let's take a step back and look at the whole picture we've just built. We've tracked a completely logical, step-by-step life cycle. Step 1 is the credit sale, documented by the invoice. Step 2 handles any hiccups or returns using debit and credit notes. Step 3 wraps up the month's activity into a neat little statement of account. And Step 4 finalizes the journey with a payment via check, which is ultimately verified by the bank statement. Every single document logically triggers the very next one. And that brings us to the end of this explainer. We've seen how a simple piece of paper is actually the absolute lifeblood of financial data. It's not just tedious administration. It's the absolute truth of what a business is actually doing. So I want to leave you with this one thought. If every transaction leaves a paper trail, what story are your source documents telling about your business's financial health? Are they organized, accurate, and telling a clear story of growth? Or are they a messy, chaotic pile just hiding errors and potential fraud? The answer is sitting right there in the paper. Keep learning, keep organizing, and I'll catch you in the next one.